Two big topics in the market this week, getting clarity on US trade policy, if that ever happens, and of course earnings reports from big tech companies. We hear Wednesday from Tesla and from Alphabet. Let's get more from Zachary Hill, Head of Portfolio Management at Horizon Investments. Great to see you, Zachary. We all know that story of the poor frog in water that is gradually brought to a boiling temperature. The frog doesn't notice it happening, allegedly. You feel investors are a bit like that. They've been in this weird tariff environment and they've kind of forgotten how strange it is.
Yeah, good to be with you, Andrew. Yeah, I do think that's a pretty apt analogy for what we have going on right now. I mean, over the last couple months, the policy volatility that we've seen has been truly extraordinary. We went from 2.5% effective tariffs in the U.S. to, expecting about 10 or so percent. I think now we're looking like we're going to be in the 15% range and potentially higher, closer to 20 with sectoral tariffs when they get implemented. But all of that has occurred over such a long period of time, and there's been so much back and forth. The shock to the China tariffs in early April and all that really it's been hard to parse out any impacts, any tangible impacts in this in the hard data. And I fear that we have this August 1st deadline, and we may be in that same type of a situation where we truly may not know, how much of an impact we've seen on the economy, from the last few months of tariff back and forth until it gets to be, a November kind of time frame. And that's quite a long ways away for a market that has a short attention span.
Could the other side of it be that investors just don't realize how bad the economic damage is here?
I mean, potentially, but I wouldn't get overly carried away with that. I mean, we do have a situation where the economy is more resilient, than we had thought possible. We have really strong balance sheets, and company managements have been able to manage through just really difficult times over the last, 5 or so years. And so there's a latent resiliency which keeps us from getting too bearish. But at the same time, we do think we need to kind of keep this idea in the back of our head as this year rolls on. Not really at the moment. We're not trying to fight, but we have a very positive momentum in equity markets at the moment. But we are keeping this in the back of our head, as we get into a kind of a full market once the summer season is over.
It seems like a long time ago that Mark Zuckerberg was in the penalty box for huge capex spending at Meta, but people seem to have forgiven him for that. We've seen Meta, as you know, go to record highs since. But will big cap spending on things like AI be an issue on the earnings calls?
That's definitely something we're going to be watching. I mean, over the last couple of quarters, investors have rewarded, by and large, mega cap companies for investing heavily in the future, and they still believe in the transformative power of AI to drive efficiency and margins, and we believe that too. And so that's going to be something that we're going to be watching, in this week and next week, as we see reports from the top, from most of the top of the market, to see how investors react to those numbers. There's been a lot of news stories, around AI talent wars over the last few weeks.
Yeah.
And so when companies come out and report, we're going to see, has the bar been raised in investors' minds, and are they doing enough to to stay ahead in what is a very competitive environment?
And certainly Meta itself has come off its high, its record high of June 30th. Yeah, it's interesting. These massive millions of dollars offered to AI specialists as these companies compete for them.
Yeah, I mean, more broadly, I do think this idea that the Mag 7 is a monolith is really getting a little bit stale. There are some companies that have done, quite well within that cohort. There's some companies that are not named in that cohort that have done quite well in terms of monetizing AI, and there's some that quite frankly haven't. And so I do think we're, searching for a little bit of a theme at the top of the market to see if there's going to be any differentiation. But broadly speaking, it's still been a pretty narrow, market environment where, breadth has been pretty poor over the last few weeks. And so we'll see, what that means for earnings and how markets react over the next 2 weeks.
You say your highest conviction call right now is a weaker US dollar, partly because the Fed looks likely to be cutting when other central banks aren't.
Well, that's one part of it. The other part of it is just foreign investors repatriating or hedging their U.S. exposure. We've had a situation where the dollar has been a correlation benefit for foreign investors, and what we've seen, not just in April, but really over the last couple months, is that having dollar exposure in your foreign asset portfolios actually magnifies your risk. And so we do think this ongoing behavior of investors increasing their hedge ratios, and that involves selling the dollar in the forward market. We do think that continues, and that's just something that's going to weigh on the dollar, more broadly. This is not necessarily something that's going to happen in the next 2 weeks and then it's going to be over. This is a more medium-term trend that we think has staying power, for months and quarters ahead.
Dividend growers, though, I guess some investors just stick with those, rain or shine. But you think that's a promising area right now?
Yeah, I mean, I think when you're thinking about sort of what we've seen in the market, we've had the top of the market and a lot of really speculative type growth stocks, retail favorites, really driving things, whereas your traditional value companies have just really, really lagged. And so, if we want to cut through some of that noise, we think being in that part of the market kind of in the middle that has, high quality and is able to grow, the bottom line, be able to grow dividends is an area that you can kind of cut through some of that volatility. We still need to have tech exposure. We still need to have AI exposure. But, that's an area that I think as a portfolio ballast is one that has proven its worth so far this year.
And we're very tight for time, but you say we're not in a recession, so avoid the hardcore defensive stocks in the United States. Would that be makers of household products, or what would you mean by that?
Yeah, I mean, staples, healthcare, utilities, those types of things. You really, especially where we are today in terms of valuations, you really need a proper R recession to get those things to work. And so that's an area that we're staying away from. We're not getting too terribly cyclical either. Small caps, they've had a really tough time with interest rates. And so we kind of want to be in the middle there as we wait for direction from the overall economic data and we see what corporate earnings have to say over the coming season.